Recommendations we put forth, Senator Kennedy.
Just give me a number if you would.
I don't have a number. Our recommendation is it needs to be studied.
There's
Give me a number.
I would agree with Mr. Kelly that it needs to be empirically based, and
Come on, guys. I know it ought to be empirically based.
Okay, well, I'll
me a
say
number.
this. The one can.
But you're telling me here today, all of you, we've got a problem. And
Correct.
We're not going to, this isn't directed toward you, sir, but we're not going to solve this problem by pondering our navels. We're going to have to come.
Folks, I just watched Senator John Kennedy grilling a panel of so-called banking experts. And I've got to tell you, this is exactly why people don't trust Washington or Wall Street. The question on the table? Should the FDIC insurance cap, right now sitting at $250,000, be raised all the way up to $20 million per account? Let that sink in, $20 million. And the back and forth between Kennedy and these witnesses is a perfect example of how out of touch the financial world really is with ordinary Americans like you and me.
Mr. Rice, you think we ought to raise the deposit limit to 20 million, right?
And that's for payroll accounts, sir. Yes.
And Mr. Harrison, you agree with that?
I think that'd be helpful, yes, Senator.
Mr. Kelly, how about you?
The recommendations we put forth, Senator Kennedy.
Just give me a number if you would.
I don't have a number. Our recommendation is it needs to be studied and empirically based.
Okay. Mr. Podsiadly?
Yes. Yeah, thank you, sir.
My colleagues are impressed that I can pronounce it.
I'm very well done.
I'm kind of impressed myself.
I used to get a lot of starts with a P going in my undergraduate in high school.
All right. I'll call you Scooter. How,
I'll take that as
give me a number.
I would agree with Mr. Kelly that it needs to be empirically based, and
Come on, guys. I know it ought to be empirically based.
Okay, well, I'll
me a
say
number.
this. The one concern
You
that I
used
do
to work
have,
at FDIC. Give me a number.
yeah, well, the one concern I have is some institution loading up on a significant number of $20 million deposits that then ultimately.
So if you don't like 20, give me a number.
I don't have one off the
You're
top.
not going to give me a number.
I will give you my best guess, which is that 250 is not high enough, and 20 million is probably too high.
How much?
I said 20 million is probably too high.
Okay.
Because I worry about.
Let's suppose we go to 20 million.
Yeah.
Banks are going to pay this through assessments, right?
Yes, correct. Risk-based.
Okay. Mr. Kelly, who's going to push back among the banking community?
Senator Kennedy, I'm not sure who will push back on that.
All right, Mr. Harrison?
I think there's some smaller banks that will feel they don't need it. Their deposit accounts aren't that large, and they would be, not as willing to do that. I think some of the banks that currently have coverage for free will likely push back. Or
Some of
implicit-
the what?
Some of
Larger
the
banks?
banks that have implicit coverage
Some of the larger
for
banks?
free. Generally, the larger.
Some of the
banks.
larger banks?
That is correct.
So you think the larger banks will oppose it?
I don't think they'll support it. I don't know if they will oppose it.
How about you, Scooter?
I love the new nickname. I will take that as a warm regard. But
It is.
I would say that my bigger concern is the aggregation of deposits.
Who's going to push back?
I don't know that you would have any institution that would push back other than as
Everybody be happy.
well. It depends on what the cost is, right?
Mr. Rice, who's going to push back?
Not our 144 million members, sir. They'd be delighted that their paychecks are guaranteed.
Who's going to push back, though?
The bankers, sir, the large banks.
The large bank.
They're not here today, and I think their silence is implicit on their stand on this.
Okay. So here's what I hear you saying. 20 million indexed to inflation, but the large banks are not going to like it because they have an implicit guarantee. Does anybody disagree with that? Does anybody disagree? I certainly don't with Senator Warren's assessment that the big banks don't have to worry about it because they're going to be bailed out. Somebody disagree with that? Okay.
Well, let me add a little color, Senator. I think perspective. So I led a committee, and
I'm sorry, sir.
I led a committee that included banks of all sizes.
Right.
And one of the things I learned in leading that committee is that there is a lot of complexity associated with the prudential regulatory aspect of those larger institutions. Their liquidity requirements are very different than mine at $700 million a year. And so it's something that I had to become sensitive to as a leader of that group. And so while we sit here.
Kelly, let me stop you. I understand. You're a smart man and you're a successful man.
Well, I appreciate the compliment.
And I
Senator.
appreciate that. But you're telling me here today, all of you, we've got a problem. And
Correct.
we're not going to, this isn't directed toward you, sir, but we're not going to solve this problem by pondering our navels. We're going to have to come up with a number and index it to inflation. Taxpayers won't pay, the banks will pay. And then find out who's going to push back and why. I mean, that's the challenge. I understand the difficulty and the nuances and the trade-offs. I get all that.
Thank you.
And you make, I don't mean to denigrate your analysis, because you know a lot more about this than I do. But you're saying we have a problem. I'm asking how we solve it. And what I'm hearing is $20 million, index it to inflation. The larger bank's going to raise fresh hell.
Kennedy asked them straight up, "Give me a number." Mr. Rice said yes to $20 million. He wants payroll accounts fully guaranteed. Mr. Harrison kind of shrugged and said it might be helpful. Mr. Kelly danced around it, saying it should be empirically based, which is geek speak for we don't want to commit to an answer. Then Kennedy calls on Mr. Podiately, who Kennedy jokingly nicknamed Scooter. And guess what? Same dodge. No number. Just more talk about studies, complexity, and regulatory differences. And Kennedy, being the straight shooter he is, he cut through it. He said, we're not going to fix this problem by pondering our navels. We need a number. We need action. That's what leadership looks like. Now let me give you the plain, patriotic truth. Raising the insurance cap to $20 million does not help average Americans. Hardworking families don't have $20 million sitting in a bank. They don't even have $1 million. Most are struggling just to get by, to keep food on the table, gas in the tank, and a roof over their heads. So who's this massive guarantee really for? It's for the wealthy, it's for the corporations with giant payroll accounts, and it's for the banks themselves. The panel admitted it. Smaller banks might push back because they don't even handle accounts that big. Meanwhile, the big banks, the same too big to fail giants that crashed our economy in 2008, they already know Uncle Sam has their back. They get bailouts, credit lines, sweetheart deals, and implicit guarantees. And now, some in Washington want you, the American people, to indirectly cover their risks again while they pat each other on the back and call it financial stability. I call that crony capitalism, plain and simple. They say taxpayers won't pay for this, that banks will cover it through risk-based assessments. Let me translate. The banks will pay by raising fees, lowering interest rates on your savings, and hiking costs on small business loans. Do you see the trick? In the end, it's not the big banks or their corporate clients who feel the pain. It's Main Street. It's you and me, the American worker, the small business owner, the everyday saver. We're the ones who pay the price when these schemes get pushed onto the system. Folks, there's a reason the big banks didn't even bother showing up at this hearing. Their silence was deafening. Kennedy hit the nail on the head. They don't like this plan because they already have an unspoken guarantee that they'll be rescued if anything goes wrong. And why wouldn't they? In the past, Washington made sure to bail them out while everyday people lost homes, businesses, and jobs. So let's be honest. This isn't legislation for the people. It's legislation for the elites, designed by elites for elites. Meanwhile, the rest of us get lectures about empirical evidence, while the experts can't even give a straight answer when a United States Senator asks for a simple number. Now, as a proud American patriot, I'll tell you what should happen. Number one, stop propping up too big to fail institutions with implicit guarantees. If they're too big to fail, then they're simply too big. Break them up. Number two, raise protections in ways that actually help the middle class. Maybe payroll accounts deserve some flexibility, but $20 million is outrageous and unnecessary. Number 3, index reasonable limits to inflation, like Senator Kennedy suggested, but keep it realistic and focused on protecting workers, not billionaire corporations. We need leaders like John Kennedy asking the tough questions, cutting through the nonsense, and standing up for the American taxpayer. This is about accountability. It's about fairness. And it's about putting Main Street before Wall Street, farmers before financiers, and families before faceless corporations. So, patriots, I want to hear from you. Should the FDIC limits skyrocket to $20 million per account? Or should we draw the line and demand policies that protect our people, not the global banking cartel? Sound off in the comments, share this video with your friends, and remember, America only stays free when we stay vigilant. God bless you, and God bless the United States of America.